Hello everyone, I hope you can hear me now. Welcome to this webinar about ID generation for 2020. First, Happy New Year to all of you. All the best to you in 2020 and let's make the most out of it. So sound is good now. So in the next 60 to 90 minutes, I will cover some ideas and bullet points for 2020. There will be obviously more than those ones, but that might help you getting the big picture and generating ideas. So let me share my screen with you now and go. And let's start with this. So there won't be any Q&A session at the end of this presentation because this presentation is going to be very long. But if you have any questions, please feel free to ask me on contact@gregoiredupont.com, or you can reach me on Twitter, LinkedIn, Facebook, whatever you want. So after a strong 2019 performance across asset classes, 2020 could be a very challenging year. So the diminishing impact of central banks, the slowdown of the world economy, the tariff war between China and the US, the US presidential elections are some of the challenges faced by the markets going into 2020. So what you want as an investor is always to be looking at what could be the unexpected events, and those are the tough ones, like the recent tensions, for instance, between Iran and the US. So those ones, you can't predict them. Still, you want to have the picture of what could happen. So don't get me wrong. I'm not going to bother you about the Middle East and pretending that I'm a Middle East specialist. And if you want to find some these days, especially on Twitter, you can find plenty of them. So in this webinar, what I will try to do is helping you navigating those conditions with the help of tools that I've been building through the 4x4 process. So let's start with what we will be covering today. First, we will be looking at the past returns from 2019 and over the last 10 years. Then we will be looking at the S&P 500 predictions, both the target, the earnings growth, and through the lenses of the P. Then we will be looking at the outlook coming into 2020, what brings the election year, the Fed expectations and the yield curve, meaning overall the credit market, the oil market, the US dollar. And then I would love to spend some time on some global themes and on some special situations. So what you want to be doing as an investor is you want to do the following. You want to be looking at what happened, and this is what we're going to be doing in the first part with 2019 and the last 10 years, and what is ongoing, and what do you think could happen with those different expectations. For that, you want to have different time frames from the very short term, as this week has been showing, with, for instance, Iran-US tensions, to the longer term picture with, for instance, the economic cycle. In 2020, in that sense, we have been lucky with already some short-term volatility with different catalysts coming. Next week, we'll really have the earnings season that will start to kick off. Then we will have more color on the Democrat elections, and we will have, as always, the meetings from the central bankers, the presidential election that will be heating up, and even more further down the year. So, for instance, in the first 2 weeks, we had Iran and the US, and we will have the deal between China and the US that should be signed before the 15th of January. So if you look at the Chinese yuan versus the dollar, the Chinese yuan has been strengthening versus the dollar and is now below 7. So that tells you that probably a deal is already priced by the markets. So what you want to be doing is putting in your calendar all those big catalysts, and then you need, as much as possible, to be ready for the unexpected with a good risk management. So let's look at 2019. So 2019, this is a perfect clean sheet where we had risk on in 2019 across asset classes. So from here to there, everything was positive. The technology sector is leading the pack in 2019 with roughly 50% gain, but almost all the sectors experienced a double-digit performance in 2019. Despite all the noise around the dollar was quite muted. So a very low performance from the dollar. And that tells you that you shouldn't be making a difference between the noise that you see, for instance, on Twitter and the reality. What we have at the moment is a very powerful rally across asset classes and across risky assets, driven by futures and options, and very little volume on the cash. There are some explanations that I'll try to give later, but this is the current development of the market. Another strong factor contributing to that rally has been, for instance, the share buyback program done by companies. Those things are fine as long as you are generating enough free cash flow to cover dividends and share buybacks. Otherwise, the share buybacks are a ticking bomb. So if you go these days on social media, you will see many accounts that will tell you, I told you so, I knew that the market will be up 50%. And many people now are in the position of the fear of missing out. So from my experience, I can tell you that we are at very stretched level on many indicators. That doesn't mean that the market is not going to go higher, but literally we are at high level. So be extremely careful here. Very often the market is stopping when it goes hand in hand with people pretending that they were long, that you should go long in this, that they have been making that much of money. Very often it is coming from people that have been ex-sales trader, market makers that have not been trading for the last 10 years. And literally be careful. Risk reward as a long here feels to me as not being a great one. And this is in the short term. So what about the last 10 years? So the last 10 years coincides with almost the bottom of the market in March 2019 and the following economic recovery. Still, we get two lagging asset classes, the commodities and oil, with the emerging markets that were underperforming massively. That could be explained by the end of the super cycle from China, which has been a big impact on those two sectors. Otherwise, you can see the return annualized over the last decade have been absolutely outstanding. So what is interesting here, and this is the question that I often get, how could we identify a market turning? At the moment, and for the last 10 years, the market is moving up, and there is no change to that. There has been some drawdown, but not much. So for any market, what you need to be looking at is the internals, meaning how the different asset classes are behaving and doing. So if those leading sectors at one point are underperforming or outperforming, and you should do that on different time frames. So when I do the mentoring program, this is really something that I'm working on. And in 2 weeks' time, I will dedicate a webinar to those drivers, to my mentees and the 4x4 subscribers. So at the moment, we know that tech, semiconductors are on a tear. That means that as long as they are performing like this, market will grind higher. There won't be any change. So let's look at now the economic cycle. So as I've been saying, the past returns have been hand in hand with the economic cycle. The economic cycle that started in June 2019 has more than 10 years left. That doesn't mean that it's going to stop. And actually, you can't be basing your analysis just on saying we have been 10 years into the cycle, so this is the end. But that tells you about the odds and how extended this cycle has been. One of the biggest reasons why this cycle is extended is because there has been a huge intervention from the central banks that are making the cycle longer, and some one-off effects like the tax cut that we had in the US in 2017 and 2019. But what you should be keeping in mind then that since 1945, the average expansion is roughly 64 months, so roughly 5 years. So again, what you should be keeping in mind, economies are 80 to 90% of the time experiencing expansion. So now I would like to move into the S&P 500 predictions. So at the start of any year, you will always have the S&P 500 predictions from the different analysts and macro banks. That is honestly, from my experience, a very hard game. And very often, this is the blaming game. So what you do, you look at the expectation at the start of the year, when you are at the end of the year, and you blaming anyone. Honestly, this is hard. They are by no means the magic numbers. And just to give you an example, so this is coming from FactSet, and this spreadsheet was coming on the 12th of December, where the bottom-up target price for the S&P 500 was 3,300 on the S&P, which is roughly 150 points from here, or 4 to 5%. So that's the target, that the average target that analysts have on the S&P for December 2020. In reality, and again, this is from FactSet, industry analysts on average have overestimated the final price of the index by roughly 9%, 1 year in advance during the previous 15 years. So that tells you that analysts very often overestimate the final value, and that was the case 12 times out of 15, and only 3 times they underestimated. So by definition, analysts, banks have a tendency to be more bullish than bearish. Why? Because 99% of their clients are long-only people, and they want the market to go higher. So similarly, second spreadsheet, here we have the target, and we have all the target from the strategist. As you can see, it goes from 3,000 to roughly 3,400. This is the same picture here with different banks. And what I think is interesting is something that we'll be looking in the next slide, is the operating earnings. So since October 2019, or September, October 2019, the S&P 500 is up 14% in a straight line. So it goes up every day, every week, every month. So we had different factors that could explain that. First was the central banks repumping the system since September 2019, the Fed doing a bit of repo, QE or not QE, depending how you name it, ECB very active. On the positive hand side, the economies have been stabilizing since September, October. So instead of the market pricing a possible recession going into Q1 or Q2 2020, it feels like now the economies are doing better. So the fear of recession have been coming down. On the technical effects, you still get the share buybacks, the passive investment, and a market that is massively driven by options and gamma positioning. So that gives you what? That gives you a market ripping higher in low volume. So if we look at early 2000 or even more recently in January 2019, a market like this could be extended. So what I'm saying is don't go against it. Just know that the market is extended. You should be looking at option positioning, calendar expiries, when there is a possibility that the market could turn. At the moment, it is for the short term, but in the long term, this is where the consensus is standing, both in terms of target price and operating earnings for the S&P. So let's look at the earnings outlook for 2020. Why? Because to look at the S&P 500 targets, you need to look at the earnings expectation. That is something I always do during the first session of my mentoring. So if we look, for instance, at a year ago, the S&P 500 operating earnings expected for 2019 were standing at 171, versus now they are roughly at 158. So that translates into two things. That translates into a downgrade of roughly 7.5% from January 2019 to January 2020. And that tells you that earnings in 2019 are only up 4.3%. So as we've seen before in the previous page, we saw that the S&P operating earnings are expected to grow to around 171 to 172 US dollar. For 2020 operating earnings, they went from $194 a year ago to 171 to 172. today. So what does it tell you versus the $158 in 2019? That will mean an earnings growth for 2020 around 8.8% and a PE of 18.5. So if we go back into 2019, the S&P was up 35%. Yes, it was distorted by the sell-off that we had at the end of 2018, but that tells you one thing, that the PE ratio moved from 16.5 at the start of 2019 to 19.4 at year end. Not because of earnings going higher, actually they were massively downgraded, but because of the largest multiple expansion since 2001, plus 17%. So now, if at roughly the close of yesterday at 32.50, with 172 operating earnings, that gives us roughly 18.9 to 19 times earnings for 2020. So let's compare these 19 times earnings versus what we had historically. After earnings, again, what I should mention is I'm not a big fan of looking at PE on its own. I think this is one of the mistakes that many, let's say, people are making. They tell you you should be selling stocks below 10, buying stocks above 50. This is not the way it works. This is very misleading. This is a fallacy. But this is important to be looking at the long-term cycle and how we have been positioning versus history. If you put aside the dot-com bubble, which has been into 2002, and you take into account this part, we are clearly in the last 5% or the high watermark. So in other words, as the dot-com bubble showed with PE, the PE could go much higher. So here we are at 19 times, but at one stage at the end of the 90s, we were at 24. So that doesn't mean that the market here could stop. If you think that the market could go on 24 times 172, that gives you a good upside. But we need to keep in mind that where we have been against history, we need to keep in mind that earnings have, especially in the US, have greatly benefited from lower taxes in 2017, 2018. So that's the one-off. And we had to take some basis. As before, they will be much lower. So we know that P comes mainly here, not from earnings growth, but from lower yields, because central banks have been trying to get cheap access to money. And that is very important to know the role of the central banks and what are the impacts of low yields across asset classes. But that already tells you that for asset allocation, and stocks, it is key to look at yields and those central banks' expectations. Similarly, at the start of the year, what I like to do is to be looking at earnings growth expectations. As I've said before, so roughly we have between 170 and 175 for the 2020 expectations, and that will translate between 8 to 12% earnings growth for 2020. So compare that with the past numbers, but I think what I like to be looking at is what are the expectations for this for the 11 super sectors of the S&P 500. Maybe you know, you don't know, but the S&P 500 is constructed around 11 super sectors that are here, and all of them have different impact on the S&P, different size of earnings, and different growth. So here, the consensus of 10%, as always, could be a bit high, and we need to be cautious, especially when we will get closer to the election. Interestingly, there is, like most years, huge expectations for the energy sector. So if you look at the energy sector, the market is expecting 22%. Very often, the market is extrapolating about the energy, and on the contrary, you have the financials where the expectations are pretty low. So keep in mind about start of the year, huge expectation for the energy sector and low expectations in financials. So then looking at the healthcare, which is making 42% of the S&P earnings. So that's really a big sector into the S&P. The earnings are expected to grow by 26% in 2020. So big number. Looking at this picture, you can start to think that they could be at risk. And that could be coming from changes in legislation or noise around the Democrats. So that's something that we have seen before in September or summer last year. But I think what I like to do, looking at those expectations by sectors, is allocate money on sector level. I think that XLV expectations, which are the healthcare, are pretty high. Similarly, is it realistic to expect XLI to grow by 12% if we could be at the end of the cycle, and especially if manufacturing is slowing? Okay, so let's jump now on the outlook for 2020. I put the GDP growth here for the biggest countries. So what we have recently is the IMF, even if it's not perfect, could tell you about the expectation for 2020. IMF is expecting 3.4% growth. So the growth has been slowing worldwide over the last 18 months, 2 years. It peaked in Q2, Q3 2018 in the US. If you look at the Eurozone, that was at the end of 2017 and start of 2019. And China have been consistently slowing. So the Chinese growth is still coming down. If you look back at what the PBOC, when they did their big meeting, I think it was at the end of 2019, they acknowledged the change in the business model from trying to rely on exports into going more into internal consumption. So it's going to take time. But that means two things that we already mentioned: the end of the super cycle in commodities, which was over 5 to 7 years ago. And now we need to look at the global repercussion of Chinese growth below 6%. And that is something that we have seen, for instance, on the auto sector that has been impacting the whole sector, especially a country like Germany. But the slowdown in China, which is a big driver of the global growth, is mainly due to domestic factors rather than the trade war. So here, we could be looking at companies which have exposure to China. Having said that, you need to keep that with a pinch of salt. If you look at Apple, that is making new time high, despite its exposure. Yes, there was a news this week that their sales bounced, but we can see how distorted the market could be these days. So by looking at this outlook for 2020 and how growth has been behaving, that will dictate our geographical exposure, with the US that is still leading, but not as much as before. And something that I really like to do is to look at exposure by region for any company. So you look at the US company and you say, what's its exposure, US, non-US? As the world is doing not as bad as before relative to the US, this is probably the time to be looking at non-US exposure as well for US companies. So if we look at the PMI manufacturing of the world, we can see that most of them are coming down. So this is the PMI is really giving the picture about the manufacturing that is now at low level and is still not bouncing. So we first had the spread from manufacturing to services. Now it seems to stop, and services regarding the last couple of months numbers have been okay. But the fear is if we stay at low level in manufacturing for longer, there will be another wave, and that could lead into an even more slowdown of the economies. So if we look at the US, the manufacturing is telling you that GDP growth is around 1.3%. And I think for services, you are probably around 2.3%. So overall, you're probably moving along 2% GDP growth at the moment in the US. So 2% GDP growth is good enough to have earnings growth. Then the question is how extended the market could be. If you look at this chart, it is distorted by the sell-off that we had at the end of last year. I think we always need to take different factors in our ID generation. What I find very helpful is to say what is the trend of the ISM manufacturing, and where and is it leading into recession. As you can see, for new orders, you are really at low level. If you go lower, there's a good chance that you're going to go in recession. I'm not calling for the recession. I'm just saying that we are at low level and the risks are increasing. That's the same for the ISM manufacturing. So keep in mind, new orders are very weak. So let's jump now into the election year. I've built many slides, but I want to go through them very quickly because I think we need to be cautious. Why I built those slides? Because there's going to be a lot of noise all along the year, and I want to make sure that you have enough data to survive all this noise. So what I do is, and all those two tables are from JP Morgan. So all along the year, the important date that we should be looking at, and those dates, there was going to be, as we're going to see later, a correlation with the VIX expiry. So we should have a much clearer picture of which Democratic nominee is likely to be by the end of March. So if you look at the 3rd of March on the Super Tuesday, you get 35% already that would be in. In July, you'll have the Democratic National Convention, and then you'll start to have the debate from September, October. In reality, and I think this is something that you need to keep in mind, an incumbent president has never failed to win re-election unless a recession has occurred during their time in office. So this is the main reason why obviously any president will try as much as possible to have the economy still in growth, in expansion coming into the election. What you have as well historically is the S&P 500 volatility has typically been higher in election years than in non-election years. Why? Because markets frequently reprice the probability of changes in the policies of the administration. So what I find really interesting is to look at sectors that might get affected depending if we go for Trump again or if any Democrat starts to pick up. So if you go on that website, Predict It, you can see the trend of the 6 candidates, and you can see the trend of Warren that is coming massively down. So last summer, market was concerned about the pickup in the polls by Warren, and at the same time, there was a sell-off in pharmaceutical and managed care stocks because, you know, we thought that Warren could change the story for those sectors. I found some very good comments from Legal in General that try to price what could be the impact of Democrats winning on markets. So I think the first thing that is interesting is that could lead into a higher corporate taxes. Why? Because you reversed what Trump has done. So here you will expect a significant contraction in earnings in the event of a recession. The second one will be a fracking ban. So that will obviously affect the entire US energy sector, from exploration to pipelines. Then the third that I already mentioned is Medicare for all. So that will result in the creation of something like the NHS in the UK. And that will obviously be a big dent for all the managed care, health, and insurance sector in the US. Then we have something that Trump talked about many years ago and still talking, which it will be lower pharmaceutical drug prices, and that will affect the whole sector. And this is why XLV could be at risk. Then you have the whole story that we have for the last 10 years, 50 years, which is always coming about breaking up the banks, increased regulation. That is an ongoing story. And finally, the clampdown on tech monopolies like Amazon, Google, Facebook, which we can't deny that they are being probably way too big. And that could have an effect on certain acquisition and maybe leading to some breakup. So that is something that we should be watching. So next, how the stocks have been behaving in presidential election year. So this is on Twitter from someone called Rich Kleinbauer. So for markets going higher, Trump is probably the best option. So this is the incumbent party wins. if the incumbent party loses, this is what you have from the moment the market starts to smell something bad happening. You have exactly the same on the same chart, same confirmation. If the market has conviction that there's going to be a change of president, then there's going to be a sell-off. What I find interesting as well is to look at those elections through the lenses of the volatility. I very often use the S&P 500 VIX, which is, for some of you probably know, the volatility in the next 30 days. Why? Because this is easy to understand. And as you can see, historically, volatility has been coming down into the year up to August, then it's spiking. If we look at the recent volatility, and I like to look as well at the midterm picture, in 2016, we had roughly 16% average VIX. 2017, very low volatility, 11%. We started to see a pickup in 2018, 16.6%. Last year, 15.4%. So these days we are at 12.5, 13%. And the long term is at 19%. So nice to be and important to be looking at the VIX. If we have the chance of the end of the economic cycle, a slowdown, or all of this coming against the dampening of volatility by central banks. So if we look at the spike in volatility, if you look at the VIX structure around the election, so October, November, you can see there is a spike in volatility, which is confirmed by this chart here, where the volatility is picking up. So to go into this webinar, I try to look at what have been the trade and how the performance before the elections, after the election. To be honest, I've been struggling to find a real pattern. The only thing that I could say is 20 and 60 days before the election, you can see that the average return have been poor, and similarly after. You can argue that 1 month or 3 months is not good enough to do returns, but literally what you should be thinking is 3 months before November, the risk reward is poor, 3 months after is poor. So maybe the trade is not the trade, but try to think that reduce net exposure going into the elections because it's a kind of a casino, and I think the returns are pretty bad. So now that we have done the elections, I would like to move into something that I think is key for anyone, is to look at the Fed expectations. So if you look at the last 10 years, that has always been the biggest drivers of the markets, and the biggest drivers of the market have been the central banks. So here we have the Fed expectations, and that is for the September 2020 meeting. If we look at what happened last year, we had a massive risk-on rally from December 2018 when the Fed Chairman Powell changed the Fed outlook. So around October, November 2018, the market was expecting 3 rate hike from the Fed, so roughly 75 bits rate hike in 2019. Then the Fed said we are on hold. Then the market started to price some rate cut, and we had 3 rate cuts in 2019. So the differential is 150 bips, 1.5%. So this is just massive, and that explained a lot about why we had this move to risky assets, this P expansion. But what we need to do as market participants is we need to look at what are the Fed expectations, and what I could have been adding is all the Fed meeting that are expected in 2020, and as well which amount of quantitative easing all the central banks are doing. We are talking Fed, if they are reinvesting, ECB, and the Bank of Japan. If we look at this chart, we should as well be looking at the euro-dollar market, which is very often more accurate and more liquid. And the euro-dollar market is telling you that there is a 25 bips cut expectation for this year. 25 bips is not much. At the moment, we get the inflation with the core PCE. So this is really the metric that the Fed is looking at, is at 1.6%. So it's at low level. but the consensus is not much from the Fed to do much, because they did actually a lot in 2019, like the ECB. So very low expectation. I don't think that the Fed is in a position to do a lot, because otherwise they could appear as supporting or not supporting Trump. So that could be an issue. But that tells you as well that the market is not really priced by any means a rise in inflation, any pickup in inflation. So if we look at the bond market, that's the next slide. So the bond market over since 1980, you can see that we have been in a relentless bull bond market for the last 40 years on the back of lower inflation. But that tells you different thing as well. That tells you that if the next recession, and when it will be coming, central banks will have less ammunition. That tells you that the strong performances from the bond markets that we had over the last 40 years, 20, 10, 5 years, will be hard to replicate in the future. And that tells you as well that the yields in the US, not the other part of the world, if you look at here, have been bottoming since 2013. And that tells you something important. Where is the pain trade? So the pain trade, if we look at the Fed expectation, no move, and this chart, any spike in yields could be very disruptive for the system. And this is a trade that has been working for 40 years. So imagine the leverage, the positioning. This is an ongoing trade, a winning trade for 40 years. But it is pricing no inflation. I'm not calling and saying that the inflation is coming. If we look at the wage from the NFP numbers yesterday, the wage growth was pretty muted. But still, this is what you should be looking as an investor. You should be as well looking at asymmetric strategies where you could be making a lot of money. So looking at three things: the Fed expectation, the bond market, and the inflation trade. Again, as long as the core PCE is under control and below the target, we should be fine. So let's look at the credit market quality. So that has been the new print in credit markets since 2008, 2009. You can see it's going on a big move. What is a bit concerning is the debt that has been printed is low quality, and that means that if you have a shock in the system, like the one we had, for instance, in 2015, 2016 with the oil services, that could spread into the high yield market. So we need to be very careful that there is no spillover into the other markets. In a good note, and here we need to be positive, most of the high yield market don't need to refinance before 2020. So if you look at the maturities of the high yield market in 2020-21, they are pretty low. So that's normally the pain should not come from there. What I like to look, as always, when I look at the yields at the bond market, I like to look at the yield curve. So here you get the 10 years versus the 2 years. As some of you know, we inverted at last summer, and now we are, I think if I look at yesterday, the 10 years US versus the 2 years is at 25 bips. So that tells you that there is a bit of reflation trade that is priced by the market. Still, this is low level. We should be looking at two things. Where is the US 10 years? And you can use 2%, 2.5%. As long as it's below that, we are fine. And if the yield curve is flattening or widening, and that will have repercussion as well to your sector allocation. As always, when we look at the 10 years versus the 2, when we look at the 10 years, we want to look at possible asymmetric trade. So what about another market, the oil market? So below, this is from JP Morgan. I've done, I think it was at the end of 2018, a blog explaining how to do supply and demand from oil. What you should remember is year-on-year demand is normally up on average between 500,000 barrel to 1.5 million barrel. That the production is around 100 million. And over the last 20 years, the only time that we experienced a contraction in oil was in 2008, 2009. So each time you read a tweet or you hear someone saying oil is going to come down by 1-2 million, demand is just complete bullshit most of the time, because that is pricing the end of the world. So otherwise, you have around 1 million demand increase year on year. At the moment, what we have, despite the noise and the recent volatility, the reality, the oil market is well supplied, and Saudis could increase capacity quickly. They cannot increase capacity for too long, but they still can do something. So, and more importantly, the game changer over the last 5 years has been the pickup in US production. So if you look at the US production over the last 5 years, they massively distorted the production. So they went from 50 million to 21 million. That is a differential of 6 million. So if you take 6 million out of 100, that's 6%. So they increased the overall, they took 6% market share. That is just huge. So we should be watching this US production. There have been some talk recently, and I'm not sure, and I need to do more work on it, that the US production could be hitting a top. So that means one thing, that could start to be an imbalance. And the second thing as well is that could have repercussions for all the sectors, and especially the oil services that have been benefiting. We know that some US producers are not even break-even. So if they're not break-even, they're not making money. At one stage, the clock is ticking and even stopping. And that means, again, like 2015, 2016, we could see some part of the credit market going into trouble. So now, after looking at credit and the oil market, I'd like to look at the US dollar. So here, that is the chart versus the euro. But I think you need, when you look at currencies, this is not something that I trade very often. I do from time to time trade in FX. Trade in FX are much longer. And I think you need to be careful. You need to be looking at the big picture. So if I look at this big picture, I can tell you that the US dollar versus the euro is bang in the middle between the lows and the highs. And if you look at the midterm, this is the same. So the risk reward of being long dollar, short dollar is pretty muted. So you're going to have a lot of noise. And actually 80% of the noise is coming from macro people and FX people. If we, as you remember in the first 2 or 3 slides, we look at the dollar has been muted over the last 12 months. So please try to go away from this noise. What I can tell you, that the dollar, if you look at the twin deficits, especially if you look at 2020, if the US economy is slowing, the fiscal deficit is going to increase. This is not a dollar positive. And if you look at the correlation between the twin deficits and the dollar index, you are probably talking at the dollar going into the low 90s. So be careful on being long the dollar here. I think there could be a weakening of the dollar, which is even more true if we look at the carry trade. So that means carrying and holding a long US dollar. Yes, if we look here at the US 10 years versus the German 10 years, it is still very positive to be holding the dollar, to be long the dollar and short the euro. But there is a but. Each time that you start to see the carry coming down, generally the US dollar underperforms. So we need to be careful. We know that the world has been bad for the last 18 months. Bad is a big word, but slowing over the last 18 months, 24 months. And we know as well that US, which was kind of immune to that slowdown, is not immune anymore. So after these big macro themes, I would like to go into some global themes. So the first one that I really like is the global energy. And this is in the next slide. I'm going to try to convince you, or not convince you, but explaining to you what I'll be looking at. I like to look as well at the growth versus value. I like, and I didn't do any slide, but I think the 5G implementation transition is a very important topic because it's going to have a repercussion for many sectors, the telco, obviously, the telco services, but as well the content. How can you bring content quickly to people? And I think this is a big change for all the media company. So after doing your top-down analysis and after having your big picture, you want to be generating ideas as well from global themes. And you will be, from your macro picture, deciding about asset allocation, weighting, geographical exposure, sector allocation. And in that sense, that is what we try to do with the top-down and with the leading indicators. But on top of that, and I think this is really something that I've been trying to push through the 4x4 videos, is you want to be generate ideas from global themes. But you need to be looking at possible trigger. And you have the global themes, but you can have as well, as we will see later, the special situation, which are giving you a clear trigger. So 5G, you have the trigger. We know that in the next 2 years, many telco companies, that many countries are pushing for a high capex in 5G. And that means we're going to have, in the next year, the following years, some big changes across sectors. Something that I haven't done a slide, but I think is key to me, and that started in September last year. For some of you, you remember the WeWork complete failure. But the WeWork failure is a good idea for you to understand two things. Is how high the valuations are. That means, you know, valuations are so high that some investors and many investors are struggling to buy anything for stupid prices. And that tells you as well about something that has been growing, which is the private equity. If you look at 2000 to 2010, that was mainly along and around the hedge funds, where the 2010 to 2020 were in private equity. So private equity have massively benefited from low financing and having the ability of carrying a book with less volatility. So if you offer people telling you, don't worry, you have 5 to 7 years, people love it. But WeWork is significant in the sense that it stopped the valuation. A company was not able to do its IPO, and that means that it stopped the whole private equity value chain. Why? If you want to IPO WeWork and you can't, that means you don't have fresh money, and that means you can't, as a private equity, keep on doing and buying new companies. So we really need to look at how the IPO market is going to do in 2020, how private equity, because really private equity is the biggest driver these days of asset valuation. Not the biggest, but a big driver of the asset valuation. Then I'll be looking at large cap versus small cap. So that will be in the next slides. And something that I've done as well, big time in the 4x4 video series, is the screening on dividend versus free cash flow. So why is it so important? Because you want to make sure that both the share buyback that you are doing and the dividends are financed with a strong free cash flow generation. If not, that means you are financing all of that through debt, which means at the end of the day, this is a ticking bomb. Again, free cash flow is key. So let's look at global energy. And the global energy, I look at uranium. And the idea is the following. I see three things. I see first a shortage of energy because we have more and more needs through artificial intelligence, iPad, whatever. The second one is, I think, not only because I'm French and I've been raised with nuclear technology, but this technology has improved drastically over the last 30 years. So it's much safer than before. And finally, that is a strong conviction and a reality. Renewables will not be enough to answer those challenges. So here you have fundamental drivers that could be mid to long term. Still, we know that uranium is facing political or mainstream views, and that will be the struggle. But we have some catalysts in the next 18 months with Germany, for instance, the US, where countries and governments will have to take big decisions if and how they want to do with their global energy. Otherwise, they could be facing shortage of electricity. But again, this is a but, and what is key in the whole process is you might have an idea, but this is not a trade yet. This is very important. What you want, and here I go back into a lot of trading, is you want to have a confirmation of the technical analysis and the price action telling you that this is the time to buy or to sell. So if you look here at uranium, that has been a downtrend, and that has been a downtrend for many, many years. So the idea is not to go against the trend and say, I'm brave, I'm going to take the trend in my face. You need to have the price action, the technical analysis going in your favor. So I think if we manage to go above this 11.27, 11.3 level, then there is a chance that uranium could go much higher. So here I've been, in a way, a bit lazy because I only looked at the ETF. You can do the same and obviously be looking at uranium producers or the whole value chain. Obviously, there are many names across the world, especially in Australia. You should do your own homework. But if you see price action going well, maybe that's the time to buy. And if you want to be a bit more contrarian, if you're ready to be more contrarian, like the way gold was 18 months ago, I remember having a mentoring session with one of the mentees saying, look, I want to be long gold. And we looked at 18 months, I think it was January 2021 call on the gold when gold was at 1300. And why you want to do that? Because you could have on assets like this very low implied volatility. So buying the premium for those calls is pretty cheap, and that gives you a massive upside when the beast wakes up. Okay, so that's global energy. The second theme that I really like is the growth versus value. Obviously, you heard about this one, and why I find it interesting is two things. Is if we have the PMI waking up again, I think that will favor the case for small caps, and a rise in bond yields, that is a possibility, even if its yields are very low, that will support the value stocks. Okay, so those two combined will favor cyclical. So let's look at the chart. So here I look at IVW and IVE. So this is the trend. Okay, as you can see, again, the trend is very powerful for being long growth versus value. But, and there is a but, there was a top in early September. So if you had any book coming into the end of August, start of September, you could feel the rotation from growth into value. So over 5 days, value outperformed like crazy and growth underperformed. And more interestingly, that was the same time when, or a bit later than the bonds topped. Okay, so the bonds topped and the yields bottom. Since then, the bonds, the yields have been bottoming and going higher. ECB, Fed have been helping, because I think the Fed don't want to be steepening the yield curve. And actually the ECB, I'm not sure, I think they realized that having two negative yields was not a good thing. So what you have is the trend is still your friend, but I think this is something really to watch, because if you look since last summer, it has been consolidating, and what it's going to imply, it's going to be a huge, big sector rotation, and that takes time, and that means the flows could be massive. So here, after the growth versus the value, I like to look at large versus mid cap and small. And here, this is interesting for exposure by regions. As you can see, the blue, the large caps have been underperforming. And that's the case over a long cycle, where as you are taking more risk for mid and small, you want to have a higher returns. I think two components are important here. The first component is if the US is slowing relative to the world, that means you want to dedicate a bit more of your allocation to non-US stocks, okay? And by definition, this is why the Russell underperformed, because small and mid caps in the US have more exposure to US than the rest of the world, okay? So that's That's the first factor. The second factor, which is more a risk management factor, and look, I experienced that in 2006, and that was painful. What we have at the moment, we have very low volume, very low liquidity in the system. That means that the liquidity for small and mid caps, and we are talking companies in the US between 0 and 3 to 5 billion market cap, is even lower than before. So if there is a big move, yes, I'm pretty sure that you don't have book of 50, 100, 200 million, but still, that means those stocks are going to move much more than the big caps. So we need, in terms of risk management, to be very aware of not carrying too much exposure into small and mid caps. Yes, this is tempting because they are moving up, but the liquidity is poor, and there are some economic drivers that could change this positioning. So that's the same here, same chart, S&P versus large, S&P large versus mid and small. And as you can see, recently, the large cap have been doing better. As I told you, I think the Russell 2000 performing is showing, and that is a sign that the gap between US growth and non-US growth has been shrinking. So again, through the 4x4 video series, I try to teach you how to generate ideas through special situations and trading. The beauty of special situations, there is always special situations. So the downside is you need to work a lot because this is very time consuming, and this is probably the returns are lower, but there is always something to do. So for instance, you could be looking in H1 2020 at the spin-offs and IPO. I put some of the names that are involved. So we get Technip, we get Electrolux, we get Continental, ThyssenKrupp, The Gap, UTX, NG. All those names will have a special situation in the next 2 quarters or in 2020. So if you do your homework, if you put the way you've done the calendar for macro, but you do micro here, you could benefit from it. Why you want to do that? Because again, you are always looking for trades with a possible trigger, and special situations are, by definition, the easiest ones to identify. Again, there is a warning here. This is not necessarily the easiest one to trade and play. So finally, we have the trading, and I think it comes back to my experience as both a trader and a portfolio manager. Next week, you have the earnings season kicking off. You get technical factors that are more and more important for the market, as I said, through options, gamma, expiries, and you have unexpected events. Those ones, obviously, you can't predict them. You need to be ready. And you need to be ready through a strong risk management and a strong setup. Finally, you can benefit from this low implied volatility if you want to have exposure. If you want to build a book these days, actually the cost of insuring this book is very low. So let me explain to you what is the 4x4 video series. And this is how I've been conducting and trying to find all those ideas. So it's about learning how to consistently be making money over time. So I have no interest of the last 3 to 6 months of people telling you at 30 to 50, I made this and this. This is complete bullshit. You want to be making money over time. So this is a very comprehensive online trading course. And it's a combination of, as we've done before, top-down process with bottom-up active trading and special situations. So this is what I've done at both portfolio manager and prop trader. What I want you to have when you do the 4x4 video series is to teach you how to diversify your portfolio across asset classes, as we've done, FX, bonds, commodities, with obviously a core portfolio around stocks, because I think this is the best universe on earth. Then you discuss how to optimize the P&L, and what is very important to me, and I think this is really something that works very well for people that have done other so-kind education, is getting a strict risk management. What I want you to do, and this is what I've been learning years after years, is you want to limit your downside and improving your returns along the learning curve. So you will get 40 videos, which are more or less 30 hours of footage, and more than 45 spreadsheets. What is key for these 45 spreadsheets, and I give you access to the links of the website, because I want you at the end of this 4x4 video series to build your own infrastructure. So I don't want you to say, oh, come back and I don't have the tools. You'll have all the tools to do it. And I think this is a game changer. So you'll have two different access. So the 2 months access, which is roughly $2,000, and the 12 months access, which is $2,500. Again, you make the decision if you are ready to spend 2 months or 12 months. The product was launched in October 2019. So far, I had very, very good feedbacks from rookies and from people that have done other education. You can read the testimonials that are on the website. So again, this is the summary of the 4x4 video series. If you go on the website, you can see the name, you can read at the name of the videos. At the same time, I do the mentoring program. So I've been doing the mentoring program for 5 years, and now these 5 years have been even better, because over the last 2 years, I really work on my own products. So these are 12 weekly one-to-one online sessions on Skype over 3 to 5 months. That way we can cover at least one earning season. And again, what is key for me is to build your infrastructure to support your trading process and become independent. So this is why we're going to be covering the macro indicators to generate quality trade IDs across different asset classes and regions to profit from macroeconomic trends. On top of that, we do bottom-up and we do special situation and trading. So that will add some performance. So the idea is to consistently generate positive returns by building a balanced portfolio using different asset classes, time frames, and strategy. So as I've been saying, I've been mentoring now for more than 5 years. So I have a good experience at having a good process and customizing the mentoring program to the students' needs. So conclusion to this webinar, I hope you enjoyed it. The world economy is slowing from peak that we saw in 2018 and 2019, and the outlook improved from September 2019. So that means there is low risk of an imminent recession. In the meantime, the stock market was helped by central banks, by internals, by share buybacks to go up 15% in a straight line. So they have been very helpful in this push. What you know, said looking at fundamental, a lot is priced in. That does not mean it will not go higher, but the risk reward to me is pretty poor. So the only thing that I could tell you is, and I've done the mistake in the past, do not go against the price action, okay? And we know as well that the market has a tendency to overstretch, okay, overstretch actually. And we don't have any need to play kamikaze, okay? Again, in the short term, the market looks quite overbought, and it's going to be interesting that the earnings season is starting, because we need a real pickup in earnings to see the markets going higher. What I would love you to do and to learn from today is you need to be looking at different time frames, from earnings, for instance, to the elections that we're going to have in the next 6 to 12 months. In the long run, we know one thing, that the central banks have less ammunition and companies are taking more risks. So yes, the cycle is longer than before. And that is a good thing, that the central banks are doing their jobs, which is putting liquidity in the system and making the system work. But still, if there is a blip, it's going to be much harder for the economies to withstand those blips. I want you, and I hope you understand, that you should be closely watching the yields and how the leading indices sectors are behaving. You should always be going for companies with a strong free cash flow generation, and as well be making more returns by benefiting from global themes, special situations, and trading. As well, the low volatility that we have been experiencing over the last few years offers great opportunities to both hedge your portfolio and take directional bets. So finally, I want to tell you that between Christmas and New Year's Eve, both my activity and family went under attack through different ways online. My family was threatened, my content offered for free online through fake Twitter accounts, Gmail account, and Dropbox. That is bullying, threatening, and copyright infringement. This is totally unacceptable, and just to let you know, my lawyers are working on this. So on a positive note, because I think it's better to end up in a positive note, I hope you enjoyed this webinar, that you will have a good 2020 and in managing your money and with your family. As always, I hope it helped. If you have any questions, please feel free to DM me or send me an email and I'll be happy to come back to you. Have a great weekend and see you soon in other webinars.